properties. But a lot of real estate investors aren't quite like him, and they may be a real estate investor without maybe another job or being self-employed owning a company. So all their income's coming from that real estate portfolio. That presents some challenges because of the qualifying criteria for conforming loans. I'm talking Fannie Mae, Freddie Mac, versus what are the other options that you can access that cash if you're not going to meet the qualifying criteria in terms of calculating or confirming or documenting your monthly stable income and then calculating a debt ratio. That's where you run into trouble when you're a real estate investor.
I think that probably solves that first question here. Share the typical challenge a real estate investor faces when accessing the equity from their rental properties. And is there more to that, or is that really the first hurdle that they typically challenge with?
That's the first hurdle, because here's what happens. If I get an inquiry from somebody who's a real estate investor, or maybe they do have a job, but they have multiple real estate, residential rental real estate. They may have 3, 4, 5, a half a dozen homes that they have rented out. If you want to get the best rate as a real estate investor on a loan, whether you're going to do a cash out refi because you need to do some improvements to that rental property, or maybe you have a first mortgage at 3% that you got in 2021, you don't want to touch that, but you need to pull out 150,000, and so you're going to look at a second mortgage, whether it's a HE loan or HELOC. Well, the first step that we're going to take is, can they qualify for what I call conforming terms? Because that's where you're going to get the best rate, either Fannie, Freddie, traditional vanilla 30-year mortgage, or a traditional HELOC or HE loan. Well, we've got to document your income. We've got to calculate your debt ratio after we determine what your other recurring monthly liabilities are. Well, if you're a real estate investor proper, you don't have any other sources of income except your real estate portfolio. That's challenging because we have to dive into your tax returns. And we've got to go through that. There's a whole process. We have worksheets that we use where we have to go through and read your tax returns and plug in a lot of numbers to come up with a resulting monthly income for qualifying. That can be hit and miss. There are times when that process, and I guess what, folks, a fair amount of people in the mortgage industry, I'm sad to say, who do what I do, aren't even very good at reading those tax returns and being able to calculate that number. I'll brag a little bit. I've gotten pretty good at that. I know the worksheets very well. I can do the math. But that's always the first step, to try to figure out, can we get them the best terms possible if they can qualify based on those ATR, ability to repay rules, that were established by the CFPB back in 2010. So it always starts with looking at the tax return. And then once we do that, if that's not going to work, then we have to look at other options.